Good afternoon, everybody. This is Stan and Jack, and we're here to do a webinar today. The webinar that we advertised was one on correlation, correlating the market because the market is one large dynamic. And Jack and I have talked. The previous webinar we never finished. And what we would like to do today is finish the previous webinar, which we were talking about patterns and using classical analysis to actually support you in day trading and also in swing trading. And so today we're going to focus more on, and we'll get to the outline in a moment. I think today we're going to finish that outline and we're going to talk mostly about reversal patterns, trending patterns, and MACD and how to use all three in trading. So I think we're going to do that today instead of the correlation work. The correlation work is a completely different topic. We'd rather finish the previous outline rather than open up a new topic at this point. Once we finish it, then we'll move on to correlation next week. That's the plan at this point. So I think everybody can see my screen. Jack, can you see my screen?
Yep.
Okay, so terms of use, everything we do is for educational purposes on the art of chart. Nothing we say here is meant as a trading recommendation. We hope that you benefit from this webinar in terms of what we're offering. And with that said, Jack, how about if we go to the outline and I throw the screen to you and we get started?
All right.
Let me find the change presenter. Okay. And you have the screen.
Okay. Right, this is the agenda. We've actually done some work on trendy patterns already. I just want to
there you
underline.
Go. Now I see it. Very good.
You see it?
Yeah, now I can.
Okay, we've done some work on trending patterns already. I want to underline it as we go on to reversal patterns, because reversal patterns are the joins between trends. So you get a downtrend that turns into an uptrend and you get a double bottom or inverted head and shoulders, or in more rare instances you'll get a wedge that breaks the wrong way or something, but you will get a reversal pattern of some kind. And we've done continuation patterns pretty well. We've talked about RSI a lot. We haven't talked about MACD, so really today I would like to talk mainly about reversal patterns and MACD.
Very good.
Right, shall we start with trending and reversal patterns?
Reversals would be good. I have a chart with a bunch of head and shoulders on it. I'm sure you do too. Wherever you want to start.
Having said that, I'm still pulling out charts. You can start if you like.
Sure. I'm just going to take a chart of oil, which is so obvious in terms of reversal patterns.
Yeah, I'm using lots of long-term charts for this.
Yeah, okay, great. This is a 1 hour chart of oil, and I'll do this while Jack gets his charts ready. So I assume everybody can see the oil chart, yeah? Okay, so all I'm going to do is I'm going to talk about divergence and reversal patterns. That's principally what I'm going to talk about. So the last turn we had in oil right here, let's just take a quick look at it. It's a very nice reversal pattern. You can see the shoulder, left shoulder, head, right shoulder. Now, when you see a little pattern like that and you see a divergence, okay, there's a little divergence right here on that low, if you will. And I'm not sure why my cursor's doing what it's doing, but let me try to get my cursor straight now. There you go. Now we have a crosshair. Okay, so we have a little bit of divergence. We have something that looks like an inverted head and shoulders, okay? Does that mean you buy it right there? Well, not really. For me, for a reversal, I want to really see the reversal happen. So I'm looking for it to break something. In this particular case, what we said was, watch for a break of this Fibonacci. Why? Because the market typically will pull back in a head and shoulders in 3 waves. Okay, like for example, this is a perfect 3-wave move, ABC, right here to this 100% fib in that yellow box. And the market could have, right here, made a choice to go lower. Okay, it could have, but it didn't. Okay, so you need a confirmation before you trade a pattern. Now, can you take and put on some risk here? Yeah, with a stop, hopefully below the previous low. I mean, you can certainly trade it that way if you want to take on the additional risk. But as you can see in this pattern, you know, a break out of this trend line right here was a great play. If you had a breakout trade and you were playing this breakout on this morning, this should go higher as you can see indicated on my chart. Now this is one reversal pattern, which is just a very simple head and shoulders. Now here's another example of a very simple head and shoulders. You can see it here, right? But it didn't break out. It didn't even get up to the 100% fib before it turned and reversed. So reversal patterns are not necessarily completely reliable. No pattern in trading is 100% reliable. okay? They aren't, okay? You just have to look at these as like, for example, this pattern, even this pattern here, they have a probability of maybe 60, 70%. It doesn't mean that they work every single time, okay? Now, of course, if you have a head and shoulder pattern and the head has a little divergence with RSI, your odds go way up, okay? Here's another small head and shoulders pattern here. You can see it, okay? And you can see that the high has a small divergence, okay? That's what you want to look for, is something like that. Now, here's what I want to say. If we go to the S&Ps for a moment, let me just go to the S&Ps and I'll throw it back to you, Jack, on the head and shoulders question.
Yep.
The other day we said on ES, for example, and also on the S&P, we had a 30 handle move straight up. If you remember, we were calling 50s as a support. Okay, let me go to the S&Ps proper. We were saying to expect, a 30 handle move. Okay, we were saying from here to expect something up in the 90s, maybe even 2100s. Okay, the thing I want to point out is, well, here we are all the way up here. We have a new high. Would you short that? Well, why would you short that? Because there's no reversal pattern yet. So the thing Jack and I talk about a lot is, when are we ready to short this move? Well, we don't have a reversal pattern yet. Once we have a reversal pattern, then we'll have something to short. Do we have a divergence? Yeah, we have a very nice divergence on the S&Ps. Is this ready to go down yet? Well, not until we see a reversal pattern. So what would that look like? Okay, I think this is a little too far gone, Jack. Would you not agree to be a double top?
Yes.
Okay, so
it's too large. It needs to look, at least to a degree, like a double top.
Yep, and this, to me, at least in my book, and we talk about this a lot, double top, a little bit too far gone. So, you would want to see something like this. Okay, we'd want to see this maybe put in a head like that. We'd want to see a reversal pattern. Ideally, it comes down here, like I have already drawn, and then it would obviously, come back up here and do something like that, equivalent to perhaps this high here. Now you have a reversal pattern. Okay, that would be a nice clear head and shoulder reversal pattern. Or maybe you see something like this. Let me just delete these so they're out of the way. Or you see something like this where you get a pullback and it may not even go that far. It may only go this far. And then you have a double top of some sort where you have perhaps a minor lower high. There's a reversal pattern. Okay, so looking for reversal patterns, the advantage of knowing reversal patterns and understanding them is it keeps you from getting into a trade too soon, because until the setup is there, you're putting money at risk too early. I think that's the advantage of understanding reversal patterns, and when they set up correctly, that way you can put your money at risk at the right time. Putting your money at risk too early can be a problem. Okay, so that's what I have to say about head and shoulders, Jack, and reversal patterns, and I'm sure you'll talk about double tops. Let me throw it back to you and get your perspective on those two topics. Jack, are you there? I think you're on mute.
Right, yeah, sorry. Okay.
No
I've got some
problem.
interesting ones to show today, and I think one of my favorite ones. I mean, the Nikkei is a tremendously technical index with a number of simply beautiful Nikkei charts. This is the prettiest, although not necessarily. It doesn't give you an awful lot of the pattern information. It gives you the main patterns to go along. This is what I would describe as. It isn't a Fibonacci fan, but this is a. You can see you get you have a thrust up out of resistance, you have a retracement, thrust up, retracement. Each time you establish a different fan line, and Nikkei's been doing this since 1990. Anyway, I digress. But what I wanted to look at was the longer-term yen patterns. Now, there's a degree of inverse correlation between the yen and the Nikkei. So when the Nikkei was spiking up a couple of years ago, the yen tanked. This is my longer term chart. This is one of my largest patterns actually. This is a rising megaphone that has taken 30 years to form, which is an impressive amount of time. And at the moment, just going to have a quick look and see how we got here and where we're likely to go next. Now, this was a pattern I'd been following for years, and the closer up version of that is this one here. And this is a very nice rising wedge that had been forming since 2007 low, and it was, for years, yen was a flight to safety destination. As the stock market was tanking, people were flying into the yen, which was ridiculous as the Japanese are frankly bankrupt and their currencies. As soon as they manage to get inflation going, they're going to drown it. But nonetheless, you know, perception is everything. And but there was going to be a time when the yen was going to drop. This rising wedge was promising that this was likely to come sooner rather than later. I mean, in currency years. So I mean, you know, it can take a year or three for a currency pattern really to develop. So this one develops, and up here, late 2012, it finally breaks. You have a first breakdown. You often see these. So you've got your trending pattern here. You get the first breakdown, and from that stage, this is when I would say, generally, you are in the topping process. What's the topping process on here? Well, we're forming a head and shoulder pattern. A fairly clear one. It's upward sloping. It's actually, this is a very nice, I mean, this is a very technical, the yen is very technical, but one of the advisories on head and shoulder patterns is it's a good thing when the shoulders are the same height, regardless of whether or not the neckline is sloping. What have we got here? We've got a shoulder that's mainly down here, but has a spike up to almost exactly the right level. Beautiful. Really nice. So this actually then breaks down here. I call it short here on the basis that the reversal pattern is clearly already there. So the initial break was here, you form the reversal pattern, you break down here, and it's a sucker bet. Realistically, it's going to complete this head and shoulders. It's got an inflection point there, and then it's likely to go down. So I called that down to that area there with the full wedge target here, which has actually now been made. Now, what pattern did we form on the way down? Well, yen rather likes wedges, so what do we get? We got the falling wedge. I do apologize. Hang on. That's my spam line. It's, the landline just gets spam nowadays, really. Anyway, yeah, this is annoying.
The key thing there, Jack, is the second break of the trending pattern. The channel that I had, also your wedge. It's like when it breaks the second time in this particular case, that's the area where you have a confirmation that it's now playing out. So I think there are situations where you get head and shoulders and it continues higher in this case. Okay.
Yep.
So it's the second break of that trend line in this case that actually is the break of the trend.
Yes. Now in this case, the falling wedge from here is the first break, which is actually the break. But now that we've broken this, we now need to form the reversal pattern. Now what I was saying in chart chat very shortly after this broke up was that we were likely to, well, I was watching this area here, and if we saw a reversal here, I said we might be hanging around for quite a while forming a right shoulder on an inverted head and shoulder pattern. And that's exactly what we're looking at here, and that's exactly what it's been doing. Chances are, occasionally you will find they will break down and make a double bottom from here, but realistically this is breaking up. These are the target ranges, these are the main target ranges here, and this is a double bottom, sorry, an inverted head and shoulders that will break up and will get us to approximately the 92 area. So that'll get us to the 23.6% flip. At that stage, we may well then form a larger reversal pattern. And you will often see this when there's been a very large move. And this is one problem with buying breakouts. You see a lot of retests. If you buying here would have actually been okay, but on a lot of if you bought this breakout here, then obviously you've got a problem. It then spends another 8 months peaking, forming the reversal pattern. You don't actually get your money back until about a year later. So that's if you've managed to stay in the trade that long, which you probably haven't. Now here, you can see the reversal pattern forming. That's going to get us up to 91, 93. Is there an obvious target? Yes, there is. If you look at the longer term charts, and this is part of the value of the longer term charts, what have we got here? We've got broken megaphone support. And if that were to retest, that would be in the 95 area. The 95 area, because this pattern will get you to 23.6. The 95 area is approximately here. You'd usually expect to see, hang on, Right, you usually expect to see a hit in this range here, the 38, 50, or the 61.8. So the retest would be at 95. Depending on the speed of the retest, you can see actually if you wait a year and a half, which isn't actually an awfully long time in yen terms, you can then hit it at 38% fib in approximately the 9900 area. This is just things to think about when you're trading the yen. But this is a very nice reversal pattern that's forming. The trending pattern has broken. The reversal pattern is forming. It's likely to break up. When it breaks up, it'll get to the first target, which is the pattern target at 92. It doesn't have to reverse there, but it often will anyway.
Now there's another aspect here. Can you go to your closer in chart?
Yes, I can.
That you just had there a moment ago. Well, not quite this
okay.
chart. The one that we were looking at.
Yeah, this one.
Yeah, there you go. Now, there's another factor here that you may want to consider, which is the nature of time in a pattern. Okay, so you see the low there, right? The left shoulder. The difference between the left shoulder and the head. We need to have a somewhat close, it doesn't have to be precise, but usually within 80% of the amount of time. So you could see like well, it seems to me like it probably needs another, what are those bars, Jack? Are those weekly bars?
These are weekly bars.
Yeah. You could use the box method and draw a box between the head and the left shoulder, and then take that box and drag it over to the, move it over so the left side of the box is on the head, and it would give you a rough approximation as to where the turn should happen.
Yep. But if you were taking the symmetry of the shoulders, where have you got the left shoulder? Now, the left shoulder is this period here to this period here. On that basis, actually, we're in about the right area now. It could turn up really at any time. And again, you'd be looking for clues on that on the daily chart. Another thing you'll also look at on reversal patterns is what's the RSI looking like? All bullish. This is a bullish pattern, bullish signal that's played out, but on the RSI 14, obviously it's some way from target. This is a very nice bullish setup, just as this was a very nice bearish setup. Huge sell signal and lovely reversal pattern and bearish pattern that it's coming out of. Very nice. It's is this one going to go all the way back up to the top? I really don't think so. It's, I think this is just a way station on the way down, but it's overdue a bounce, and it's going to get one. All right. I'm sorry. Got more to say, Stan? Or?
No. Actually, you do see, of course. I'm assuming the larger head and shoulders as well.
Yes.
Yeah.
But that's easier seen on this chart, and that is obvious here. How long did this left shoulder take to form? It took 1, 2, 3, 4 to 5 years. Currencies, these things can take a while, just like bonds. You can be watching a pattern form for 5 years before it does anything necessarily that's particularly interesting. But here we may well be forming a right shoulder for 5 years, and at the rate that they're bankrupting themselves, that's probably a reasonably good level to continue the journey down.
That's a good guess.
So very nice setup there. Shall I show some more?
Yeah, sure. Let's do the double tops, double bottom type reversal patterns.
Well, hang on. I'm just looking for some on that you usually get. Yeah, you've got one on this chart here. It's
they're everywhere.
This is coming out of a falling wedge. You can see the lines there. You've got the break, and you got the retest. This is a very classical double bottom setup. They're not quite, they're not quite even, but I've got a lot of double bottoms. They don't have to be at exactly the same level. There are rules which, for me, are fairly meaningless. I think it needs to look at least to a degree like a double bottom. There has to be a rough equivalence in terms of the size of the move from loads, the bottom to the top, and I'll quite often on a target where you've got different levels here give 2 targets. I quite often do that, and actually I've got a brilliant example of that on the DAX. I'll just show you that one.
Yep.
Now hang on.
I have another double bottom example here for the S&P as well.
All right.
And a couple of double tops too.
Yeah, there's quite a few. I mean, but This is a rising channel on the DAX. It then forms what looks as though it might be a head and shoulder forming, but then is a double top. It's not a particularly great double top though in terms of the symmetry. So what I've done here is I've called two targets. These are the up arrows, which are measuring one high, and then it's measuring the second high, and then I've done two arrows of the same size pointing down. You can see this is the alternate double bottom target, double top target, which is lower, and this is the one which is higher. And you can see it's come down, pretty much exactly made the lower target and bounced from that. So that's a very good example of an asymmetric double top. And that's why I give two targets on these. If they're at the same level, then obviously it's just you take the higher of the two and you take the target from that. But it will often hit the lower one when you've got an asymmetric one. All right, great. And you want to show?
Yeah, I got a couple of double bottoms here. I just want to share and talk them through a little bit with RSI. Okay, great. Thank you. Let's look at double bottoms here on the S&Ps, and we have just lived through this, so it's a great example. I think it's probably current in everybody's memory. So here we have a trending pattern. Everybody see the trending pattern, right? We have a double bottom right there. Okay, so I had this drawn earlier, and I've taken it off the chart since then. But I would have a trend line on a trending pattern, especially if it's in the declining position on the upper side of the trend. So there I am on the upper side of the trend. I have the double bottom, right there it is. I have the divergence, right there it is, okay? And now I know there's a turn that's about to happen, okay? Do I put my money on here, or do I put my money on after I break the trending pattern? Well, it's always safer to put your money on after you break out of the trend, okay? Because just because you have this in a divergence, very often divergences break. Do you remember last week we had a divergence on the S&P? Remember right here? And we came down and we broke it. So, divergences do not always mean that the market is going to turn. It gives you a 70% probability that the market will turn. So can you put on some down here at a double bottom? Sure, you can. But I would be adding after you confirm that the trend is actually broken. So there's a double bottom, and what do we do? A three-wave move, okay, up into this area. And we break this trend, okay? And then we come down and we put in a larger double bottom. Okay, and again, we have a divergence on that double bottom as well. Okay, so double bottoms and head and shoulders, typically, you're going to see RSI divergence, and that's a really good giveaway that we're about to get a turn. Now, that doesn't always happen, and again, I always come back to this. Nothing is a sure thing in trading. Look at this right here. Okay, if I go to a lower level chart, there is a divergence on this high. Okay, but there is a small head and shoulders pattern here. There it is. Okay, but it's kind of a wide head and shoulders pattern, and it's not. There's a small neckline here. It really didn't go all the way to target either. Okay, so they're going to be difficult turns that you're not going to always catch. But if you look for reversal patterns, double bottoms, head and shoulders, and use RSI to your advantage, it'll help you pick out when trends break. And of course, use trend lines for that. So, Jack, would you like to cover anything else, or shall we move on to MACD?
Well, actually, I just want to show a sequence over a number of years.
Okay. Let me give you the screen, and I'll get something set up for MACD.
All right. Now, again, as I was saying in a couple of weeks ago when we were talking about the trending patterns, this is all basically a sort of organic, as it were, sequence. These things flow into each other. So what have we got here? We've got a rising megaphone. This was a little tricky to work out the pattern, but this is a head and shoulders here. That goes into a falling wedge, very clear, inverted head and shoulders there, which actually breaks up and fails, making what is more of a double bottom, which then morphs into a triangle. You've got this strong resistance there, and then that breaks up, I put in the triangle target here, which is from there to there, makes almost exactly the target slightly above, and then breaks down. It's you've got this makes a inverted head and shoulders. Sorry, head and shoulders. This makes an inverted head and shoulders. This triangle, things do get hijacked by triangles. When things start going sort of in a narrowing range and targets stop being hit and so on, then you are often in a triangle. It's and this is a nice example of one here. But as you can see, even the triangle makes its targets, generally speaking, as well. Breaks up and off it goes. That's you just have to recognize these things when they happen and be patient. It's patience is a very, very key market skill. In terms of the Nikkei, actually, I'd like to show a dollar chart. Again, these things repeat. I'll show what I mean on my long-term dollar chart, where I've got a very nice. This is this chart goes back to this is an agreement in 1985. The Plaza Accord in 1985. It was an international agreement to devalue the dollar. As you can see, it was a huge success. So this is the dollar going up, and this is the dollar going down. Very hard. But I posted this a couple of years ago, and let's have a quick look at this. And I was talking about the comparison between the current period, we were about here, so I recall it's 2013. I was talking about the comparison between the current period here and the current period, and this period here, which was during the tech bubble. And as you can see, we are trading a range, sort of very much a rectangle look to this actually, but it's basically a double bottom forming. Then breaks up, makes target, fails. It's which you will see a lot. Now things don't need to fail when they reach their reversal pattern targets, but they often will do. So you need to be aware of that. Here I marked in the arrows for it. This may actually be a huge double bottom, which would reverse the entire move from the Plaza Accord agreement. We're not there yet. It'll be years before we know that for sure. But if we're up to let's say 115 or 120 by 2020 or something, then I'll be taking this very seriously as a pattern. It's in the interim. Here we are, declining channel, inverted head and shoulders, mostly forms, fails. You get that a lot. When it fails, it tends to travel quite a way in the other direction, and it did that. It's it's very much a process, and you've got to have some idea of where it might be going. But here, you see the big picture, and on the Nikkei, again, you see the big picture. What's the big picture on the Nikkei? Well, this was the all-time high in 1990. It has never yet been challenged since. Is it going to be challenged? Well, possibly, actually, yes. It may be that it's only challenged because the yen is becoming rapidly worthless over the period of this chart. And during this rise here, the Nikkei has been rising and the yen has been falling. And actually, they've got mirror patterns essentially. What are we looking at here? Well, the Nikkei is probably going to retrace if it ever gets to it. And the yen is looking up. Chances are they will move in opposite to each other, and then they will turn together again. Where will they turn together to? Well, the yen potentially has a very long way further to fall. As Stan and I were saying, this is potentially forming just a very large head and shoulder pattern. What's forming here on Nikkei? Well, I think this may well be a very large inverted head and shoulder pattern. It looks like a double bottom, but actually this is the head. You've got resistance here, right slap bang in the middle of this area here. I've had this line marked for years now, and as you can see, this exactly peaked at this huge neckline. And it should, in due course, when we've waited long enough, retrace here and form a right shoulder. When that breaks up, then I think the Nikkei actually has a run at taking out this high, which will have lasted a minimum, really, by that stage of 30 years, possibly as much as 40, before it was challenged again. So this is very much a sort of 1929 high. I think the 1929 high was taken out in 1954, if I recall correctly. This is a similar sort of setup. You're seeing a very long-term pattern forming, and the obvious next step is decline while the yen is rallying, and then a huge rally, during which time the yen is probably going to disappear off the map, pretty much. In terms of, well, possibly drop a third from its current level. in value. All right. Yeah, I think this covers the long-term view. There's a similar view on the dollar. I'm less confident the dollar's actually going to get back to the 1985 high. But, I mean, the possibility is there, and you need to be aware of it.
Yep.
All right, great. What should we do next?
I have a MACD chart just to finish off what we said we would finish off, so we're kind of done with the outline. I want to finish off MACD.
Actually, do you want to show a DAX chart first? Because I just want to have a look at one of the international indices. I was looking at a chart with interest tonight, and it's one that has some... All right, this is the DAX daily chart. And do I have a chart which shows this better? No. Right, you've got this rather messy double top here. I did think it did look as though Head and Shoulders might be forming here, but it's broken up. We had a falling wedge which broke up there. Where is the reversal pattern? Well, actually, it's got a reversal pattern, and it's broken up. And that reversal pattern is an almost perfect double bottom, which is broken up with a target. I'd marked this in quite a while ago. It's got a breakaway gap here. I'm looking at this thinking, that's really interesting because the DAX has a high probability target here of 11,700. And this is a strong pattern. It's a very nicely formed double bottom. You've got a very clear, I mean, I actually haven't looked at the trend lines for this in, we dropped the international service a couple of weeks ago. It's been at least 2 weeks. I drew in all these lines when we were down here, I think. But I drew in this potential double bottom, and it's come up to it. It's gapped over resistance, which is a very strong way. I mean, obviously the advantage disappears if you then go and fill the gap. But this is a very strong setup. Gapped over there, breakaway gap, not filled. It's got a double bottom target at 11,700. Generally speaking, on any instrument looking at a setup like this, I'd be assuming it would make it. Generally speaking, with 80% plus odds. So that's interesting. But again, it illustrates the point. You have your trending pattern, and then it breaks, and you're looking for your reversal pattern, which I was doing here. And it's broken up, which is very interesting. So, yeah, very interesting. All right, great. Let's do MACD then. Passing it back to you, Stan.
Great, thank you. I'm just going to show you another way of looking at divergence and another way of looking at breaking trending patterns and reversals using MACD. Now, sugar is a great study, first of all, in a long-term bottom, and also looking at either divergence or MACD with trending patterns and reversal patterns. And I'm just going to walk you through a chart. So here is sugar, and here's a trend. Okay, everybody can probably see that. Pretty clear trend, right? Now, what do we see here? We see a potential head and shoulders, and what do you see on MACD? Anytime you see a head and shoulder pattern, you see a divergence. Do you see the large divergence? It's typically found if you count WXY in the third wave position. That's where your MACD is going to be at the highest, right? And then when you get your higher high and a lower MACD formation like this, that's a clear divergence. MACD shows divergences much more easily than RSI. Okay, you can really see them clearly. So here I see a divergence, right? I see a break of a trend. I see a back test of a trend line. Folks, that's a dead giveaway. That is a dead giveaway. Oh, I forgot about this trend line. Here's the major trend that this has been in for over a year, okay? And so we back test this trend line, we back test that trend line, we have divergence, we're out of the channel, we've broken the trend. That's just a gimme right there. That's an easy trade, okay? They don't get any easier than that, okay? So again, same setup here. What do we have? We have a trending pattern, okay? There it is, right? There it breaks. What do we see up here towards this high? We see a very clear divergence on MACD. Right there it is again. Okay, so and where are we right now with MACD? Do we have a divergence here? Well, not really quite yet. Is this maybe the third wave, and maybe we will see something like this if we get a little bit of price action higher? Yeah, it's more than likely going to happen. But MACD is a dead giveaway when you have a 5-wave move, or even if you don't count waves, if you do nothing but trend lines, watching for reversal patterns, double tops, head and shoulders, okay? If you do nothing but that and use MACD for divergence, you will be able to get into a trade with lower risk, because this move here where you put in the high, that's not the move that you short. That's the move that you stay away from. When you have a spike move like that, you stay away from it. You wait for the divergence, you wait for the higher high, and then you put your swing trade on and you capture that. If you're going to, capture a counter trend move, which that was. And again, that's what you want to. That's how you want to use MACD. Now, this is useful at multiple levels. So let's go to a daily basis. Okay. Sugar is a great study for long-term. Let's go to the weekly chart, for example. Okay, here's the long-term trend in sugar. We're doing a reversal right now. We're putting in a reversal pattern. Here is the divergence on sugar. Look at it. It's a single, 1, 2. This is a triple divergence on RSI. Okay, so we go to a daily chart. And what do we see on MACD? Well, we see a divergence here and we see a divergence here. A double divergence on MACD is a killer buy usually. Okay, so the other examples I've shown you on MACD, these were single divergence examples. And typically on a 1-hour chart, you're going to see single divergence. That's what this is. That's what this is. Hopefully there's a single divergence coming here. We'll see. But on a daily chart, you're going to see double and triple divergences. And usually the double divergence is the one that's the most important on MACD, because that's the one you actually want to you want to get into. Okay, I think that using, again, trending patterns, look at the reversal pattern here. Here's the shoulder, here's the head, here's the shoulder. You have a divergence. Okay, so that's a low risk buy situation right there. And we did not see this going quite this high all the way back up to this upper channel, but that's clearly where it's headed. And going down to a lower time frame chart again. This is setting up. This is actually compressed right here. Do you guys see it? The RSI is compressed, which tells me there's probably going to be a big move coming soon. And we've talked about triangles and compression in RSI. I'm not going to belabor the point, but you see compression in RSI, it means something's about to happen. Is it a radical turn, or will it be the finishing move? One or the other is about to happen here in sugar. So that's a very quick look at trending patterns, reversal patterns with using MACD. Okay, again, MACD is another way of looking for divergence. And Jack, do you have anything you want to add on MACD? I think we probably need to take questions. Folks, by the way, there's a questions tab. If you have questions, please post them. I think we're about to take some questions here in a few minutes. I'm going to pass the screen back to you, Jack, for a MACD example.
All right. Well, the other way you can use MACD, and the divergences, to be honest, divergences are my favorite. It's I would often look no further, but actually there is another way you can use MACD, and that's well worth looking at. So I'm going to show this Apple chart from a couple of years ago. Mining my website for examples now. Right, here, the other thing you can look at on MACD is the crossing of the lines. Now, this is a very common thing on a lot of moving averages. You look at see where the lines cross, because quite often, where the lines cross, you get a very nice trend. For instance, here, you get a cross there. It's starting off rather low. When it crosses, you are at the low, pretty much, slightly before or at the low. So here you've got fairly good, you're already looking at a very low level where you'd be thinking about a buy anyway. You've got a bullish cross where the black crosses over the red. Hang on, I'll just blow this up slightly so we can see slightly more clearly. So you've got a bullish cross where the black has crossed over the red, and you get a very nice trend out of it. As with a lot of these things, they tend to perform best at extremes. Everything tends to perform best at extremes.
It's much more reliable that way. Absolutely.
Yeah, this is it. I mean, so if you've got a setup where it's at an unusually low level already, then your chances of having a winner are much increased. So to come at a level where MACD is at a low level which it hasn't seen in many years, ever, as far as I can tell, actually. Although I haven't got this back to 1980. And you've got a MACD cross there. That is a very high probability. The other crosses, though, they led to nice trends. You've got a cross here coming into the 2010 high, and this happens beforehand. You get a nice retrace there. You get a cross again, a bearish cross, black going below the red before the slightly before the 2011 high, and again it delivers. That's you've got. The point I was illustrating with this chart was actually I was mainly looking at the RSIs on here because I was illustrating a different point about extreme weekly sell signals on the RSI. It's but you could follow the MACD on this, and obviously this is you can't really see it in the detail on the scale of the chart. But I mean, the fact is, this is a very useful tool, and it's well worth adding it to your toolbox. It's
absolutely
one of the more useful MACD crosses. So it's not just a matter of looking at the divergences; it's also a matter of looking at the crosses. In terms of the divergences, what have we got here? Now, this is a chart I was posting in 1st of October 2012, and what I was doing was I was forecasting, to general derision, a large retracement in Apple. What was saying here? The RSI divergence we're seeing at the moment is always signaled a swing high, lasting at least a few months, with the smallest retracement being 15% in 2011. And I was talking about this RSI divergence here. Got one here, here. They all of these previous 5, the average retracement was, I think, 40%. And actually, I think it retraced 50 in the end. So it delivered. What do you notice about the MACD here? Negative divergence.
Yeah, right.
Very clear, matching RSI. Yes, another signal. And here is more or less the point at which it is topping out. And it retraces, and slightly to my surprise, actually broke this trend line here, which I wasn't expecting.
Yeah.
Sometimes you do get surprised. But I mean, very nice tool. All right, great. Have we got any questions?
I think so. Let's go to questions. Hold on, let me open up the questions tab and see if anybody has posted anything. If anybody has questions, please post them. This is the last webinar on day trading using classical analysis. We're going to do the next one we're going to do is the one on correlations. Jack and I wanted to finish all the topics on this. We may do future webinars on classical analysis as well in more depth. So the next webinar, let me just talk a little bit about that, just in case anybody has questions. We don't have any questions yet, Jack, so I'm waiting on a question.
Okay.
The next webinar, we're going to look at how you correlate the market, and like, for example, the different correlation tools, like using with gold, for example, the gold and Kiwi. The Kiwi currency actually correlate very well together. And to show you on what basis do you use correlations, for example, to trade gold, and how you would use the Kiwi to trade gold. Another correlation that we'll probably look at is looking at the Australian dollar and Canadian dollar in relationship to oil. Okay, looking at, for example, junk bonds and how it correlates with the S&Ps. So there are a number of different tools to use to correlate your trading, and I think correlations are very important because it gives you a sense of what the broader market is saying. Okay, for example, when are we in a situation where there is a flight to safety type situation, and we'll go through charts showing how the market correlates in different types of market conditions. I think that's the learning around correlations, and so we'll cover that in detail next time. We're going to go through the tools that Jack and I use to correlate the markets. And I think that, again, in general, the market as a whole is a dynamic, okay? It's not like you're trading one instrument. You're trading an instrument that's connected to a larger financial system. And if you can get your arms around that, it really helps your trading in terms of predicting which direction the market's going to go. Okay, so we do have a question, Jack. What is the shortest time chart we can still get a good signal in MACD?
All of them. 1 minute, and you can get a decent signal.
Yeah.
I use all of them from yearly for the very occasional long-term look, quarterly very occasional. I use monthly a lot, and I use all of them down to 1 minute.
Yep.
It's and the 1 minute I use all day, every day for intraday trading. all the patterns, all the indicators we're talking about here, they all work on the 1 minute chart.
Yep. Everything we've covered on all these webinars, it all works on 1 minute. I think when you get to a tick chart, it's a little different. Okay.
Now, actually, while we're looking at this chart, just struck me there is a thing on correlations I'd quite like to mention.
Huh?
No correlation is perfect. Yeah.
No,
if you trade as though a correlation is always going to be perfect, you will get tripped up sometimes. And actually, this chart's a very good example. And the reason I pulled up the current version of this is if you look at this chart here, what I'm doing is I'm forecasting basically a 40% decline in the Apple share price. Yeah.
Yeah, that's right. That's right.
Yeah.
Mm-hmm.
How well correlated is Apple with the general stock market on this chart? Pretty damn well correlated.
Mm-hmm.
What is the inference you would take from that correlation? Well, if the Apple chart's going to go down 40 to 50%, then chances are the market's going to struggle. When is the date on this? It's October 2012. So what happened while Apple was losing 40% of its value? The market went up like a rocket. And that is something you always need to bear in mind about correlations. And we are in fact talking about this period here, which covers quite a lot of 2013. Here you have Apple going from, at current values, 94 to 52. So you had a very classic, that was what, 46%, 47%, right in the range that I was predicting on that 2012 chart. What happened to the market generally? Well, when Apple fell initially, the market fell too, and then the market went up like a rocket, and Apple continued falling, going down.
Mm-hmm.
After that, after Apple was finished with the move, the correlation returned. That's, that is something you need to bear in mind about correlations. No correlation is perfect. If you trade them as though they are, they will bite you.
Yep. There's some correlations that are more reliable than others. So like, for example, any stock in relationship to the index itself, like Apple or any other stock in relationship to an index, I would not use that as a really good solid correlation. You have a high probability, but currencies against other commodities, far more reliable. So there are some reliable ones, but even they aren't 100% reliable. Okay, I can show you instances where the Aussie, for example, and oil diverge. You know, it does happen. And I do have Apple finishing a move here, Jack. Just so you mentioned the decline you're expecting. I'm looking at.
Oh no, this was the decline I was expecting in late 2012. No,
I'm talking about the decline that's about to happen. Anyway, I thought we're getting off on a different topic. Let's move on to the next question. Len has a question on the crossover between the black and red lines. Just could you explain that again?
Right. Okay. It's let's have a look at this monthly Apple chart, because I've got this one up here.
Yep.
Let's just blow that up. Right, this is cool. This is the difference between, and you get this across when people talk about the death cross or any moving average cross, what you're looking at is a bearish cross and a bullish cross. Now, how do you tell which one is which? Well, in a bear trend, the red line is the top one. In a bull trend, the black line is the top one.
Right.
Yeah, and the cross is the transfer between those trends. You will find these chop around sometimes. You can get chopped up as you can, get chopped up on any setup in the market on them. But you will find that when you reach an extreme, they tend to get more reliable. Here you get a cross back slightly, and then down. Yeah. You're getting your divergent lower high here, while prices make a higher high here. So MACD will show negative divergence.
Hey, Key, if you can go back to that for a second, Jack, just to mention something here, Len. You see the divergence there on MACD, right? Once a divergence happens on a daily basis like that red line and black line not crossing, that's a great aid in terms of how long do I hold on to my swing. So let's say I see the divergence, okay, and I look at my indicators. I see that divergence on a daily basis, and I see that the trend starting. The black crosses over the red. Well, I'm in my trade either already or I'll get into my trade. But as long as that red and black do not meet, do not touch, I'm holding on to my trade. So people who have a hard time holding on to a trade, use MACD, okay, especially when you see a divergence, because typically after a divergence, the red and black stay separated for a while. Now, it may not be as long as this. I have to admit, that's a very nice swing trade. What is that, about 5 months? Okay. On a lower time frame basis, the same thing applies. Whether it's an hourly chart or a 4-hour chart, I think those would be good charts to use for a swing trade, and be able to hold on to a trade longer. Using the tool.
And actually, in terms of divergences, what did you get at the bottom of that move? Well, you got a divergence. I haven't got it marked on this chart because I haven't actually updated this particular chart in a couple of years. But at the bottom of that trend, you got the RSI divergence, you got a MACD divergence. The trend finished with, you had this nice long trend here, the MACD crosses. I do like the monthly charts for longer term signals. They're really good.
Yeah.
I use the monthly charts a lot. And here you have a very nice solid trend up into the end of 2013. This has been a very good guide to when to stay and when to get out. In terms of where we are now, well, we actually had another one of these divergences like this one. We had this one here, and we make a higher high on the index here, and to be honest, that's almost the top. Getting negative divergence on RSI. You haven't actually got it on MACD, you don't always get it. But you've got it on RSI, you get a very strong sell signal. It hasn't actually quite made target. All of the others made target.
Yep.
I'm wondering whether there's more coming.
There is more coming. I think we're going to go see, roughly speaking, like the 125-ish area on Apple, and then I'm expecting $98. So we got a big, I think we have a big fall in Apple coming.
Well, if you think about it, on this setup here, on this chart I posted in 2012, I was talking about the smallest retracement being 15%, the average retracement was 45%, and we've got another one of these signals here. If you were to take the same amount there, you'd be talking really about a decline of, 60? That would give you a very, very rough target of 73.
Yeah. I don't know that 92 will be exceeded, but we're going to be in the 90s here in the next 3 months or so. We'll see. Anyway, let's see if there are any more questions. By the way, Len says, great, understand. Thank you, Len. I think that's it, Jack. I think that's a wrap. No other questions that I see. And folks, join us next time. We're going to be publishing a new schedule of webinars, and that'll be up probably later this evening. Jack, thank you very much. Always a pleasure. And
thanks, man.
We'll see you guys next week on Thursday. Take care. Bye-bye.